Hello, this is Lee McFarland from Kinship Investments. How are you? I am here to review our previous week, and because it's the beginning of the next month, October 1st, 2017, we might as well review our September returns and how we did and what we're looking at, and maybe just our monthly returns to date as well, and that'll most likely bring up a lot of interesting thoughts for me, like margin and how I ended up evolving my strategy itself over time. So I'd like to start off with, if we can get up over here, a chart of how our month went. And it was spectacular. We ended up making 12.78%. And I kind of feel weird starting my video series when I had such a great month because, you know, as you'll see, like I have evolved my own strategy so that, yes, I'm now feel that I am fairly successful in what I do. You know, these are our private business accounts. They do have a couple clients in there as well, but we don't have much money, and we kind of made a lot of mistakes, right? And I'm not here to do that video of my past mistake. You know, I'm here to say, well, yeah, we did really well, and that's not always the case. But I think with a good strategy, you have ways to mitigate your losses and mitigate how well you do. Yeah, so where we want to start is for the month. I'm just going to pull up my own chart here, which kind of shows me as well, so that I can talk about it as I look at it. So the beginning of the month, it was a pretty steady month for us. We had a little bit of a down blip, I guess, between the 12th and the 18th, around about, so about a week there. And that was because it was 2 weeks ago when natural gas declined in price quite substantially in one day by about 3 or 4%, which declined what we were holding. And I'm going to hit this every time because this is exactly what we do. This is what we do all the time, and that's trading iron condors. We specialize now in just trading iron condors and crude oil and natural gas. We were dabbling in wheat, soybean, corn, treasuries, you know, just a whole bunch of others. But we stick with options on futures on CL, which is crude oil, and NG, which is natural gas. So why? That's because of the implied volatility that they have. You can get, and the liquidity, I should say, and they trade monthly. I know the QQQs, the SPYs, all these other things that are ETFs and indexes, and also Amazon stocks, you know, these sort of things, they have great liquidity, and they sometimes trade weekly, right? Which is great, so you can get in and out on a shorter term scale. Why I like the natural gas, crude oil, options on futures, those sort of things, is because you can go very far out of the current price with your iron condor. And I'll just quickly remind people, like, if you're not too sure, like, there's tons of stuff on the internet to figure out what iron condors are. But basically, in a nutshell, it's so simple. You have a price. So let's say you have a price of crude oil at $50. You're going to sell a call up here, and you're going to sell a put down here. Okay, so your call could be, let's say your call is $60, and you're going to sell a put at $40. Okay, so if you just had those two, that would be called a naked strangle. Okay, and actually that's what we started doing, like, back when, and I'll get to that in a minute once we review, like, our year so far. That is okay. You get a credit, right? You sell a call and a put and you get a credit. So that's great. You're like, oh man, I got some money and I'm away from the price, and it's fairly safe, that sort of thing, and I just have to wait till it expire, and I made that money. No big deal. It's a great return. The problem is the margin. okay, you have potentially unlimited risk. So if that crude oil increases in price towards your $60 call from 50, well, that call is going to get more expensive, which means what you sold it at, you're losing money. So if you sold it at 1, it could potentially be worth 2. So now you've lost $1,000 because crude oil is 1,000 times. That's the multiplier. So these sort of things you have to think of when you're starting, and we looked at that, and that seemed to work with us for a little bit, and we played it safe, and we made a good like 2 to 4%, 3% average a month, and that was okay. But anyways, Iron Condor is simply now to protect that and to cap the margin and cap the risk, is instead of just selling that call and selling that put, you're now buying a call just a little higher than the one you just sold. Okay, so now you decreased your credit, right, that you made, but you've capped the risk. So instead of making $1,000, you've now made only 500. But now you've capped your margin, and your broker goes, "Wow, this is great. We are going to say that this particular position, you need to have $500. Let's just say." Whereas before, it could be unlimited. The crude oil price might move, and it might go to 55 from 50, and the next thing you know, your $500 margin is now $2,000. So that really is not a good strategy. You need to cap your margin, you need to cap your risk. Okay, so on either side, if you're calling your put that you sold, you have to now buy a call and buy a put. Okay, and that caps your, and I see there's a cat behind me now, so that's great. Meet Sarah, my resident cat. So so that's what's happening this month, after the one down period of natural gas. Around Thursday, I think it was the 18th or so, yes, Thursday the 18th, natural gas popped back up, which, and for whatever reason, we had a little bit more risk on the downside. So when natural gas did move down, our positions increased in value, which was detrimental to us. So that's why we had a small down period then. From the 18th, natural gas kind of meandered sideways, went up actually quite a bit on Thursday the 18th by about 3 or 4% again. It popped back up, so it went down, popped back up, and we made money again. So it's so it was a good month for us, because after that, crude oil, natural gas kind of, for the most part, meandered sideways. I know crude oil, I'm looking at the chart over here. I have charts all over the place. Maybe one day I'll actually turn the camera around so you can see everything that I do. But I'm going to be posting a lot of stuff as well. And since I'm here at this point with crude oil, which is really interesting to me, I was just reviewing this, and I had a trader in here late last week just to kind of discuss what they're doing. They're just getting going themselves, and I was just kind of giving them pointers, and we're just chatting and having a good time. And I was showing them that what to possibly use as a new trader to help with your decisions. And I really think that RSI is a good indicator for any directional trades. We don't do directional trades. We do credit spreads, and we play the house, so to speak. So we make money if the market's going up or down or sideways. It doesn't matter. But I'm going to bring up a chart, and now you can see, this is, I just like to use 6-hour bar charts, and this is what you see, 360 minutes, 6-hour candlesticks. There's no point to it. It's just what I use. So don't think it's the be all and end all. But in the middle section here, you see, yeah, there's a chart of crude oil, and going back about a month and a half, 2 months. And you can see from about the end of August, it was forming a base, and I'm looking at it while I'm chatting so I can get this straight for you. Near the end of August, around the 28th or so, it did form a base and then formed a lower low about a day later. So on the 28th of August to the 29th, it went down and then went up and then formed a lower low on the 29th. Now, if you look in the RSI chart, and I'll try to make a circle around this for you, you can see that the RSI made a W. It formed a base there. But on the price itself, it went low and then it went lower. Okay, so the price is going lower, but the relative strength, RSI, was forming a base. That's what you call a divergence. And I don't want to get too into the fact that it's a short period here we're looking at. That's not what I would trade if I was a trader in this. The point is just showing that base. Now from that base, it moved substantially up to the 6th or so of September, and then it kept on forming higher in bases on the relative strength and on the price from that point. Now here's the interesting thing. This is classic RSI, and you'll see that it hits a high on the 6th, 14th, and it went a little bit higher on the 26th of the 70 mark, okay, of the RSI. 70 and 30 on the RSI, that's the green line. You see, those green lines are fairly standard points where people say possible reversal, or if you go back through that line after crossing it, that's a indicator to go the opposite way, that sort of thing. And I'll remind people, if you're new, and this is an educational sort of thing just to get to know me as well, RSI is relative strength, and they say in textbooks and online, if you can check this out, it's comparing sometimes other things to itself to find the relative strength, but in this case it's comparing it to itself. So it's taking its average gains to its average losses in the price. So it's just taking the data price itself, and eventually, even though the price is going up, the way that it's going up is not strong, and that's what relative strength shows you. Now what's very interesting, and I had my friend come over. It must have been on Friday, late last week, and or Thursday or Friday, whatever the case was. That's near where we had a line, which is the red line above here, on the RSI chart, showing how the RSI was increasing in strength, and then it broke down. It broke down on the 28th in the morning, and the price though itself stayed within the price channel, that red channel on the price chart. It stayed within there. That is a divergence. That's what you call a divergence, and that's classic. And I wish I had enough, we had enough personal business capital to take these fun sort of trades, because in my mind these are just like stupidly simple, easy trades that you can put a nice little stop mark, your risk, but it's almost so obvious what's going to happen. And again, we don't ourselves, we're not structured to take advantage of these movements. But anyways, moving on. You'll see that the price did eventually, and this morning, I think it was very early this morning, it did decrease past the price bottom support, and it was at about the middle of the consolidation area on the 28th to 29th, was around 50.5, and this is on the sorry if people are getting technical here. This is the November continuous contract chart that I have up here. I use multi-charts, easy language stuff, and it's fed by IQ Feed as a data feeder. So it substantially went down this morning by about, was that about $1? So that kind of confirmed the relative strength, the RSI, and another clue, huge clue, huge clue. When you're looking at this as a trade, you go, okay, what happened just previous, right? So previous to the small consolidation, and I'm going to put a, let's say a green circle, okay? So I remember, a green circle around the consolidation area. Just before that was a huge engulfing red bar. Okay, this is a huge clue. We had a nice run up, a green bar just before, which was in the early mornings on the 28th of September. And then in the morning thereafter, it declined in value substantially. So that was a huge clue right there as well. So that's interesting. That I just kind of I saw that in the charts. It's something, yeah, maybe in the future that I'd have the ability, once we have enough capital, to take advantage of these small things and just, you know, sell a contract on crude oil, nothing major, and make some money. But let's get back to how we did for the year, I guess. So let's bring up a chart. So we're up for the year with our own, with our own private trading accounts. We're up about, what is it now, 27.8% for the year. We started trading in the beginning of February, and as you can see at this time, we are the blue line, and I'm not too sure if I want to put up the chart with all the other indexes. Maybe. Okay, let's do it. There you go. So the green line is the SPX. The EFA is the, I believe that's the emerging market fund index, and the VT is a similar index as well. So we're in blue, and we started in February of this year, 2017. And we started doing, like I said, strangles. We started selling, just selling, not buying, not Iron Condors. I found that I was comfortable with that. I traded those for a while, and I was just very comfortable in the risk and reward. But what I learned through time is how the brokers view your risk, and that's very different than what you may. And so we started off fairly good, making a couple of percentages, and then the next thing you know, in March we had a bit of a downturn, and that was us adjusting. So when I say adjusting, when you have Iron Condors, you have strangles, you have whatever, verticals, all those sort of things, and the price of the underlying, whether it be crude oil, natural gas, whatever, moves in a direction that substantially increases the price and risk of the particular call or put that you've sold, you possibly need to make adjustments so that you don't own whatever you're selling. So if you sold a call at $60 for crude oil and it was $50, and then for whatever reason over time the price of crude oil ended up being $61, well, that means you're on the hook to buy $60,000 worth of crude oil. And I don't want that in my backyard. So we like to go way outside of the money. So and everyone has their own parameters. These are ours. We go substantially very far away so that we have a good management of risk and very low delta. And that's something to look at when you get into options. Delta and theta is really important to us. Delta, most importantly, that's part of our system of how we enter and exit trades, is what number the delta is. So when the price and delta gets a certain point, you may have to make adjustments so that that increased price and your loss needs to be mitigated, because eventually you're going to get to the point where you're going, I give up. And that money that you've lost, you need to recoup, and you need to stop the flow of losses. So if the price comes to, let's say, let's go back to that example of crude oil being 50 and you have a $60 call. If crude oil goes to 55, you might have adjustments in place that enables you to create more money somehow, and that's what we do. We do more. We sell more in different ways and adjust it that way, and we kind of offset the increased cost for that one call. Then if it gets to like 57, let's say, then you might go, oh geez, okay, that's it. We give up, we want to buy it back, and it's increased in value to a point now where it's substantially more. But you might have a actual method like we do, where you might sell some more, and you've made money to compensate for that. So now you've made money along the way, and you've bought back the riskier item, whatever it is, that call, the $60 call. You bought it back, and now the risk is gone. And now you have other positions that you have to manage, of course, right? But you haven't really lost money. You made money at the beginning, and that was the main bit of money. And then your adjustments were there to compensate for the risk of that one call. If you didn't have to buy that back and it decreased, then you made even more money. But as we move forward into April and May, those were our strategies that we did. And come June, late June of this year was a huge lesson. And I'm what's called a certified market technician in Canada. That's a certification through the Canadian Securities Institute. And I'm also taking a lot of courses on technical analysis and these sort of things. I'm now level 2 of the CMT, which is a chartered market technician. I've been doing this for about 20 years. So those things can trick you into knowing that you think that you know what you know. And we had a position in late June with wheat. And I'm going to bring up a chart of wheat. So you'll see we were in wheat coming into May and June, and I'm going to narrow my particular chart so that I can see even clearer what was happening during that time, and hopefully I've done that to the chart above so you can kind of see as well. So this is a very interesting and a great example of why Iron Condor is a little better than spreads. What happened was, you can see in June we had a huge run up in wheat, and this is a thing with a lot of commodities that you have to be completely aware of, and you have to have good mitigation in regards to where you're in and out of your positions, and what kind of spreads you have, and what mitigation you have to take care of the losses and to get out of positions if they go to extreme values. So you can see in early June for wheat, it increased substantially from, and this is a continuous contract, mind you, from $430 to a top of $570. So that's a major increase. And at the time, you can see from our returns, in that time frame, we had the same sort of up and down movement of our returns, and that was simply due to wheat. I looked very thoroughly at wheat and I knew that we're losing a lot of money in our private fund, but I was so far out still from the price. Like we weren't at a level. Let's say at the top, the wheat price is 570. My calls were at 600. Let's say. So I knew I still had a lot of room, But that doesn't necessarily mean that that was the right decision. It just meant that I knew we were safe, and if there was a correction to take place, um, uh, we would reap the benefits of it. And if it got to a point where it went further than that, than 570, I would have had to take corrective actions, because I don't want to be again having a pile of wheat in our backyard. It's not something that appeals to me. I already have enough grass to mow. But what I did with my own analysis is that I found that there was, and I'm going back to my candlestick memory here, I think it was a shooting star, and I'm gonna do the research again, and I hope I bring up the right, or I think it was a Harmony shooting star, or as a hammer, one of the two. But the fact is that, as you can see from the chart, bring that back up, in late June on the weekly, it really showed this major candlestick, which is a huge reversal indicator. And the next week, it stayed within that area and didn't go above it, and then it decreased in price substantially, and I knew that that was a confirmation for that particular candlestick. So we left our positions, and we were adding positions to take advantage of this huge run up that happened, and selling more what's called verticals. So I was selling a call, but I was a little more careful, and I was buying a call above that just to protect ourselves a little more. And in the meantime, you can see from, okay, going back to our returns increased substantially and went up back to where they were, and we're all the way up to, I think, about 26% for the year, because we made this analysis. We're safe, and I was flying high. It was great. It was exhilarating. It was a confirmation that I made the right decision, but it was a bit of a I had to make this decision to go against our normal rules of adjustment, because wheat was moving so heavily. I could have made those adjustments, but what I found that I'm finding now, and why I'm only utilizing crude oil and natural gas now, is that wheat is very illiquid in the sense of the options on futures. If you're dealing with options that are far out from the price, and when the price gets to a certain point, and it did, I'll bring back up the price for wheat, it went all the way back to 440, that sort of thing. If you're trying to sell a put that's far out of the money from this price, there's nothing available. That is not a good product to be in. If you can't utilize your own strategies to sell and buy what you need to sell and buy, if there's no liquidity, if there's no volume, you can't deal with it. You should not be in that market. One thing quickly that I'll probably expand upon next week, because it's so critical when you're dealing with options and you're selling credit spreads, is margin, right? Your broker has a certain black box, if you will. Sometimes they have very transparent margin calculations, but my broker, who is Interactive Brokers, who is great, they have particular margin calculations, and if you're able to cap your risk with Iron Condors or verticals that sell a call or sell a put and buy a put or call just outside of that, you are now mitigating your risk to a profit factor. Okay, so, and that is not their issue. So they are able to now go, okay, well, your risk is capped. Your risk is equatable. So if the price of whatever the underlying you're dealing with is moving one way or another, that doesn't affect the margin, and that's so critical. You have to cap that margin so that you can plan. And if you can plan, then that's half the battle of trading. I'm going to leave it at that. We had a good month, and I'll see you next week. Ciao.